Good morning, dear students. A warm welcome to a new session on financial markets. In this slide, we'll focus on the meaning of financial markets. So, a financial market is a market for the creation and exchange of financial assets. Now, you would think, what are these financial assets? They are shares and bonds, and we purchase and sell these shares and bonds in the stock market. A financial market links savers as well as investors by mobilizing funds between them. The process of allocation of funds is known as financial intermediation. Now let us look into the definition of financial market. So financial market is the market which acts as an intermediary, and it makes possible the transfer of funds from the savers to investors. Financial markets mainly consist of two major segments. Number one, capital market. This market is for medium and long-term funds. So let's talk about the money market. This market is for short-term funds. Mechanism of allocation of funds. So let's take the first example, that is banks. The households can deposit their surplus funds with banks, who in turn could lend these funds to business firms. Now let's talk about financial markets. Households can buy the shares and debentures offered by a business using financial markets. Now let us list down the functions of financial market. Number one, mobilization and channelizing the savings into the most productive uses. Second function, facilitating price discovery. Third function, providing liquidity to financial assets. Fourth function, reducing the cost of transaction. Now, let me elaborate on the first function of financial markets. Financial market facilitates transfer of savings from people, that is the savers, to investors. Financial offers different investment avenues to savers, and they help to channelize their savings into most productive use. Most of the companies raise their major portion of capital from share market. Now let me elaborate on the second point, that is facilitating price discovery. Financial markets help in creation of financial assets by issuing shares and debentures, and it also helps in establishing the price of these financial assets. Households are suppliers of funds, and business firms represent the demand. So, the interaction between forces of demand and supply helps to establish price. Now let me elaborate on the third point. Financial markets provides liquidity to financial assets by facilitating easy purchase and sale of financial assets. It helps the investors to convert their securities into cash quickly. Now let me elaborate on the fourth function. The valuable information about securities are provided through financial markets. Therefore, it is very helpful for buyers and sellers of financial securities, and they can save their time, effort and money in their dealings. Now let us look into the types of financial market. So the financial markets are broadly categorized into two. One is called as money market and the other is called as capital. Now let us understand the difference between capital market and money market. On the basis of participants, in the case of capital market, individual investors as well as institutional investors like financial institutions, banks, corporate houses and foreign investors participate in the capital market transactions. However, in the case of money market, the participants are namely Reserve Bank of India, commercial banks, financial institutions, mutual funds and corporate houses. Individual investors do not participate in the money market. Now let us look at the second basis, that is instruments traded. In the case of capital market, the instruments of capital market include equity shares, preference shares, bonds, debentures, etc. However, in the case of money market, some of the main instruments used are commercial paper, treasury bills, trade bills and certificate of deposit. Now let us look at the duration of securities traded. The capital markets deal in medium and long term securities which are for more than 1 year. However, the money market deals in short term securities having a maximum tenure of 1 year. Now let us look at the expected returns. In the capital markets, investors get higher returns on their investment. However, in the case of money market, there is always a trade-off between risk and return. Low risk involves lead to lesser returns. Now let us talk about the safety. The capital market is more risky. However, the instruments of money market are safe, less risky due to shorter duration and soundness of issuers. Thank you, dear students, for being very patient. I will catch you again in the next video on financial markets.